All right, good morning, everyone. It is 7:58 in the morning of February 7th, 2023, and this is my pre-market strategy session. So this morning, the title of the video is Powell speech today, or Powell speech at 12:40 today. And he is scheduled to speak in front of let's see, what is this? The Economic Club of Washington. And the funny thing about the FOMC minutes, like, a week later, almost a week later after the FOMC minutes, there always seems to be some kind of a speech or something that Powell gives a week later. And I think there's something else that he speaks at tomorrow where he's basically going to say what he said at the FOMC minutes, except he's going to do something to there's going to be something that he's going to say that's going to be a little bit more, maybe he's going to elaborate on something that he said at the FOMC minutes or something along those lines. It's my personal opinion that it doesn't really matter what he says. I mean, it's just a matter of what the Fed does to raise rates. And now, keep in mind also that there used to be only two things that the Fed had any control over, and that's the Fed funds rate and a bank's reserve requirements. Now, that's changed. The Fed has gotten quite broad capabilities to make bond purchases, and all those, I don't know, I think there were 7 or 9 or a whole bunch of sort of special provisions granted to the Fed during COVID, and I don't remember what they all are, but it was essentially the Fed is able to go in and buy risk assets, so it's kind of like, well, all right, I think they're allowed to go and buy corporate debt now too, one of those special vehicles. I really have to go back and look, and it's probably something I really ought to go back and look at. But essentially what we've got is a central bank, which is somewhat of a centrally planned economy in some respects. There's a lot of central planning going on with the performance of our markets and the economy through the Fed. And so he's going to say something today. It's going to either cause, at 12:40 today, once he starts with his speech, he'll get into 2 minutes of it, and the market will either rally or tank, 2 minutes into the speech. That's the way it is. Personally, I really don't think that, and then after the next couple of days, I think the market's going to do what it was going to do anyway, prior to or regardless of Powell's speech. And the way things are looking to me right now, this is how I'm seeing things. So I have 3 Fibonacci's here. You can't see all of them. I kind of have them all overlaid right here too. They're different time frames essentially. So I've got a Fibonacci here of this latest move from the end of December here to the beginning of February. So basically all of January here. It's been one heck of a January. I think that's more than 20%. That's more than a 20% move from top to bottom. Actually, let's take a look here real quick. Let's see. From the bottom in December, 20.77% move. Then that's, in fact, it was rising rather steadily, and then it went a little bit like sort of blow off top. My guess is that we are going to see a retest. Actually, let me hide this one real quick here. You can see this pop up right here. What was this? This was September of 2022 right here. This little 4-day pop-up thing happening. And, things are looking really quite similar to that. So let me bring that horizontal back. This horizontal right here, there's been a lot of price resistance. And I'd say in between was at 294, yeah, 294 roughly, and 310, 15 points. A lot of support and resistance, and a lot of price action occurred in that area. Personally, I think that this bear market rally still has legs, and any excuse for a pullback to retest this 294 area and then move away is welcome. It's perfectly welcome. So there's this sort of weak bit of support and resistance right here at 300.92 on the Qs, and I'm a buyer right in here in between 300 and 294. Let's say 300.92 and 294. Over the next couple of days, it wouldn't surprise me at all to see it come down and then go back up. There's been a lot of speculation on tech earnings, and there's been a lot of talk about all of these sort of tech layoffs and so on and so on. I don't think, the reason that layoffs are occurring is so that these big tech companies can protect their earnings per share. So it's kind of like, if rates are leveling off, which is probably where the Fed is going to be. The Fed's going to be somewhere around 5.5% or so. We get a CPI reading next week, and that'll be a pretty decent indicator of, if the Fed sees CPI coming in. I think it was at 6.1% last month, and it's, it drops down. I don't know what expected is, but if it starts dropping down to, like 5.9 or, into the fives, the Fed is going to consider itself, its hiking regime as successful if inflation is coming down to meet the Fed funds rate, and then inflation comes down below the Fed funds rate. That's what the Fed calls a soft landing. Now, in the broader sense in the economy, the soft landing, Chairman Powell has said, hey, look, there's going to be more pain. We need higher unemployment. I think unemployment right now is at 3.9%. That's a little bit misleading given that the participation rate is at a 40-year low or whatever it is. I don't remember. But, as far as inflation goes, that's kind of the Fed is here. One of the Fed's, there are two mandates, and I've forgotten. I think it's price stability and employment stability, something like that. That's like the two main mandates that the Fed exists to ensure, and that is that inflation, we don't get hyperinflation, and the employment rate is steady. So I'm short-term bearish over the next 48, 72 hours. Let's see, it's Tuesday today, so we could see a kind of a slow week this week. But then I imagine that we're going to gain some support, some price support down in this area, and I will be looking to open up some swing trades in that area, and then move on from there. See what the next couple of weeks brings. That's pretty much my strategy. So I am definitely expecting in the short term, and that means within the next 24 or 48 hours, I'm expecting to see this. There was a gap put in between the 1st of February and the 2nd of February, $7 gap on the Qs. Nothing too major, but gap nonetheless. And it looks like the gap is the price action is going to come down and repair that gap. I think we're going to dip a little bit lower, just to make it a little bit scary for everybody. Maybe even go down, to retest this 294 area again, which was a significant area of support and resistance here over the past, almost a year. We're going on, that's 9 months. And so, you can see 294 here, right here, here, opened up and plunged down, bumped its head again, bumped its head, broke through, found support, then broke down below, then bumped its head, bumped its head, bumped its head, went down, bumped its head, broke through. I mean, that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 tags of this roughly 294 area that we've seen in the past 8 months, 9 months. What's it? May is the 5th month, and we're going into the 2nd month, so it's 9 months, right? That's a lot of price action, or a lot of prices hitting a same level over and over again for support and resistance. My personal opinion is that after we catch some support here, we find our way higher again. And again, I think that so the very short term, in a matter of hours, 48 to 72 hours, something along those lines, we find support down here between 294 and 300, roughly speaking. And then for the next, I'd say somewhere around 6 to 10 weeks, this rally will extend itself however it looks. We're going higher. And then at some point, this 10-year, 2-year yield is going to normalize again. And whatever it is that, rears its ugly head at the point when this thing starts to normalize again is when we get the next big sort of down move in this bear market. And that's the way it is. I think we're going into month 9 now. Let's see. Let's go 1, 2, 3, 4, 5, 6, 7. Oh, we're in month 8 now of a yield curve inversion. And the yield curve inversions last in recent history, since the 80s, since as far back as this chart goes, yield curve inversions last anywhere between 12 and 18 months. So 4 months down the road, we'll see what this yield curve is doing, if it's starting to float back up or if it's going deeper, who knows. This morning when I got in, the low was at 875 basis points. You can get 875 basis points more for the 2-year than you can the 10-year right now. Major flight to safety into the 10-year. I'd had a line at negative 100 or negative 899 basis points because I came in one morning, I sat down. Usually the first look that I take is somewhere around 6 o'clock in the morning. And this inversion, this 10-2 inversion, was as low as 899 basis points. But it was, I don't know, a bit of an anomaly or something. I mean, I marked it off, but when I came back, the bar wasn't there. It wasn't showing a tail that was that low. So I went ahead and moved it to negative 875. I mean, that's 24 basis points away from negative 899. Rather, we're in record territory. The previous record was put in back here before the dot-com bubble burst, back here in, was it 2000? Yeah, this is 2000. This low of 699 basis points was put in. And we're definitely below that now. And I don't know, we'll level out down here and start moving up. I don't know. Who knows? But until it does, and I've said this I don't know how many times now, as the yield curve is inverted, the equity markets can remain bullish. In fact, if you go back and you look at the months leading up to the dot-com bubble and the months leading up to the bursting of the housing bubble, markets were, the equity markets, the S&P and the Qs, they were all bullish up until the last couple of months before the yield curve normalized again. And so during the first, back here for the dot-com bubble, for the first 10 months of the yield curve inversion, the Qs were going up. For the first roughly 16 months before the dot-com, or before the housing bubble burst, the S&P and the Qs were all bullish. The top didn't occur until the very, very close to the end of the yield curve normalization. And so here we are, maybe, if history is any guide, 12 months to 18 months away from yield curve normalizing again, that puts us, anywhere between 4 months and 10 months away from the top or the next top. I do happen to think that the Qs are going to bring in, I hate to call it a suckers rally, but because there are plenty of people that are going to make plenty of money in a bear market rally. But my personal opinion is that once that yield curve starts to normalize again, we see the equity markets take another dive. Now, will they dive lower than this recent low? I don't know. They might dive a little bit more and then come back up. Who knows? But this rally that we're going to see now for the next few months, in my opinion, is just setting up for the next leg down. But it doesn't mean the market is the only place you can be early and be wrong. So you don't want to trade in the wrong direction. This is the way it is. So yeah, I'm bullish and looking for a pullback and to find some support in this area. Maybe some of Powell's comments today and tomorrow will help us get down into this area a little bit, and then we'll find some support after he doesn't have anything else to say for a little while, and we'll start moving our way back up. So yeah, that's pretty much what I've got. VIX is still hovering around kind of high here. This low put in back in August on the VIX. We're kind of flirting with that line right now at 19.12. I would prefer to see it go lower than 19.12. I mean, 19 is still kind of high. It's not over 20. Over 20 is usually kind of sketchy, but 19 is still kind of high. I'd like to see it drift down to 15 or so, and that'll bring us a nice big rally, at least for the short term. Let's see, the dollar. Yeah, the dollar's caught a little bit of a bid here. It's to be expected. I mean, look, this thing over the past, let's see, it was that September of 2022. There's been a 12% move in the dollar to the downside. It's huge. For currencies, these are huge moves for currencies. So, actually, while I'm looking at it, let's take a look at gold here real quick. There's Bitcoin. I'm going to go to metals. I think that we're setting up on the Qs and on the S&P for what gold is about to start doing. In my opinion, this is a sucker's rally on gold, and that much lower prices are in store for the foreseeable future. It's going to kind of come back, and what it did on the way up is what it's going to do on the way down. So something like that. All right, everybody. Good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell. Thanks for tuning in, and I will see you at tomorrow morning's strategy session. I am out.